Hello there. If you're involved in crypto here in the UK, you are going to want to listen up. We're about to break down a massive shift in how HMRC is looking at digital assets and what you absolutely must do to get ready. A huge thanks to the expert team at My Tax Accountant for putting together this vital briefing for us all.
Right, let's get straight to it. From 2026, the game is changing completely. Every single sale, every swap, every transfer you make, it's all going to be reported directly to HMRC by the platforms you use. The days of flying under the radar, well, they're officially over.
So you've got to ask yourself that question. Is your house in order? Over the next few minutes, we're going to give you everything you need to answer that with a confident yes. Let's dive in and find out exactly what's coming and what on earth you need to do about it. All right, here's what we're going to cover. We'll kick off with HMRC's new era for crypto, then we'll get the basics for the 2025/26 tax year sorted. After that, it's the main event, the 2026 reporting revolution. We'll look at the costly tax traps, give you a solid game plan, and then point you in the right direction to get some expert help. Okay, first things first. Before we can even think about the future, we have to have a solid grip on where we stand right now. So let's quickly run through the essential tax rules for the current 2025 to 2026 tax year, because this is the foundation for everything that's coming.
So, in the eyes of HMRC, pretty much everything you do with crypto falls into one of two buckets. On one side, you have capital gains tax. That gets triggered whenever you dispose of a crypto asset, and that means selling it for pounds, yes, but also spending it or swapping it for another crypto. On the other side, you've got income tax. This kicks in when you earn crypto through things like staking rewards, mining, or maybe you're a freelancer who gets paid in crypto. Now, the bit I really want you to focus on here is swapping. So many people think that as long as they don't cash out to pounds, there's no tax to pay. That is a massive, and I mean massive, misunderstanding that can cost you a fortune.
Let's talk numbers for capital gains. For this tax year, everyone in the UK gets what's called an annual exemption of £3,000. Think of it as a tax-free allowance. So if you make, say, £5,000 of profit from your crypto trades, that first £3,000 is completely tax-free. You only have to worry about tax on the remaining £2,000. And for anything above that allowance, the rate you pay depends on your income. It's 18% if you're a basic rate taxpayer, and it jumps to 24% if you're a higher rate taxpayer. Okay, so we've got the basics down. Now for the main event, Section 3. The 2026 reporting revolution. And trust me, this isn't some small tweak to the rules. This is a complete overhaul, a total game changer for tax transparency in the UK. And the engine driving all of this has a name, CARF. It stands for the Crypto Asset Reporting Framework. Now, what that actually means is it's an international agreement that the UK has signed up to. It forces crypto platforms, we're talking your exchanges, your brokers, to collect detailed data on everything you do. So what's the crucial point? Well, think of it like a new automated data pipeline running straight from your exchange account right into HMRC's system. And just look at this timeline, because this is happening fast. From the very first day of January 2026, these platforms are legally required to start tracking all this data. Then, by May 2027, the first huge batch of information covering the entire 2026 year gets sent to HMRC. After that, it's an annual thing. So the time to get your records straight isn't 2027, it's right now.
And we're not talking about a simple summary here. The level of detail they'll be getting is, frankly, staggering. They'll be reporting your name, your address, your national insurance number, every single trade from crypto into pounds, every swap from one coin to another, and yes, even transfers out to your own private wallets. And it'll all be timestamped with the value in pounds at that exact moment. This just brilliantly illustrates the crystal clear view HMRC is about to have. There will be nowhere left to hide.
Right. Now that we know HMRC is going to be seeing everything, it's absolutely vital to understand the common mistakes that could land you in some very hot water. These have always been traps, but with this new system, they're like tripwires with an alarm connected directly to the tax man. That's not all. Here's where most people go wrong.
Let's start with the big one, a question that comes up all the time. Let's say you've got some Bitcoin. You think Ethereum's about to pop, so you swap one for the other on an exchange. Have you just created a taxable event?
The answer is a huge, bold, unequivocal yes. As far as HMRC is concerned, you have just disposed of your Bitcoin. That disposal triggers capital gains tax on any profit you've made on that Bitcoin. You've then just used the money to buy a new asset, which is Ethereum. This is, without a doubt, the single biggest trap that people fall into, creating a tax bill for themselves without a single pound ever hitting their bank account.
Stay with me. The next point might surprise you, especially if you're dabbling in DeFi.
And speaking of complex areas, let's touch on decentralized finance, or DeFi. Here's a fantastic pro tip directly from the experts at My Tax Accountant. In the world of DeFi, you're safest to assume that every single click you make is a potential tax event. The complexity here is a whole other level compared to just simple trading. You want an example? Let's take one common DeFi activity, providing liquidity to a pool. Sounds simple enough, right? Wrong. This one single action can create at least 4 separate tax events. First, just putting your tokens into the pool can be a disposal, triggering capital gains tax. Second, any rewards you earn are usually treated as income, so that's income taxed. Third, when you take your tokens back out, that's another disposal event for capital gains. And finally, if you sell those reward tokens you earned, yep, you guessed it, that's a final disposal also for capital gains tax. It is an absolute minefield. Okay, so I know that sounds like a lot. The rules are complex, the scrutiny is about to go through the roof. It can all feel a bit daunting. But here's the good news. It's all perfectly manageable if you have a clear plan. So now let's look at the next step, getting your house in order with a proactive game plan. To calculate your gains correctly in the UK, you have to understand something called the Section 104 pool. Imagine you buy Bitcoin 5 different times at 5 different prices. Instead of trying to track which specific Bitcoin you're selling, HMRC says you have to pull them all together. You just add up the total amount you spent, divide it by the total Bitcoin you own, and that gives you a single average cost price. But wait, it's not quite that simple. Before you can even use that average price from your pool, HMRC has 2 other rules you have to apply first, and they have to be in this exact order. First, the same-day rule, then the bed and breakfast rule, which looks at the next 30 days. It's only after you've checked those 2 that whatever is left over can be matched against your big Section 104 pool. It's a crucial and often very confusing part of the calculation. And after you've jumped through all those hoops and done the calculations, you're still not done. You are legally required by HMRC to keep detailed records of all your crypto transactions for a minimum of 5 years after the tax return submission deadline. And that means records of dates, types of crypto, amounts, and the value in pounds for every single event. It is non-negotiable. So let's just recap. We have complex DeFi rules. We have these intricate calculation methods with multiple matching rules. And we have a new era of total transparency, just months away. The message from HMRC is crystal clear. The time for guesswork is over. All this complexity is a clear signal that expert guidance isn't a luxury anymore. It's a necessity. Look, getting professional help now is really about protecting yourself. It's about avoiding those costly mistakes that can lead to penalties of up to 100% of the unpaid tax. It's about making sure your gains are calculated correctly using those tricky matching rules. It's about navigating the crazy world of DeFi, staking, and NFTs. And maybe most importantly, if you have undeclared gains from past years, an expert can help you make a voluntary disclosure to get everything sorted before HMRC comes knocking on your door. Now, of course, we have to state that all the information we've shared here today is for general guidance. Tax is complicated, and it really depends on your own personal circumstances. So this is not a substitute for professional, personalized advice that's tailored to you. To navigate this new era with confidence, we strongly recommend you talk to specialists. The team at My Tax Accountant are experts in crypto tax. They live and breathe this stuff every single day. Their contact details are on the screen right now. You can give them a call on 0208 570 8531 or drop them an email at info@mytaxaccountant.co.uk to make sure you're fully compliant and prepared. And finally, for more essential updates just like this one, make sure you hit that subscribe button on the My Tax Accountant YouTube channel. Thank you so much for watching, and please, don't put this off. Take action today.